Jill. Hello, everyone. Welcome. We are so excited to have you all here. We are going to just give folks another minute or two to join. We have a ton of folks that are planning to join us tonight, so we will just give them another minute or so to do that, and then we will get started.
Susan O'Connell, that's a treat. Hello. Nice to see you.
And anyone who wants to show their face, this is in meeting mode, so we would love to see your faces if you feel comfortable turning on your video.
We know you're not commuting, so you don't have that excuse.
Let's see, Ernest. Hi, Ernest. I see you down there. There you go. We put on your video. Hi, Ernest. Hi, Michael. Good to see you, Michael. Good. Well, I expect folks will still continue to trickle in, but we'll go ahead and get started. So welcome, everyone. It's so wonderful to see you all. My name is Colleen Gregerson. I am the Executive Director of Battery Powered here at the Battery. And it's really my pleasure tonight. This week I'm getting to host not one, but two events related to Battery Powered's current giving theme, which is climate action. So some of you may have joined us on Monday night. We hosted our expert night where we heard from a group of leading experts about the challenges and solutions in the climate space. But we really focused on how philanthropy can play a role in climate action. And that was on Monday. So tonight we're going to shift gears a little bit, and we're going to look at how impact investing can play a role in action for the climate. So two different kinds of investments, two different, mechanisms for impact, but all towards the same end goals around the climate, whether that be, net zero emissions, slowing the rise of global temperatures, or averting the worst outcomes of climate change. So we're really excited to be hosting this tonight. Before I kind of introduce and kick off with our guests tonight, I wanted to get a sense of who we have in the audience. Some of you I know very well, but some of you are new to me at least. So we wanted to put up a poll just to get a sense of how much experience our audience has with impact investing already. So I think Jill, my colleague, is going to put that poll up, and yeah, you could answer if it's brand new to you, you have some experience, or if you have loads of experience. We'd love to hear that. And while you're answering the poll question, I'm just going to do a couple of little housekeeping things. We're all super overly familiar with Zoom now. So we are in meeting mode, which means that if you want to turn your camera on, we can see you. And when we get to the audience Q&A, you have an opportunity to ask your questions yourself if you like. So we do ask you keep yourself in mute for the time being until we get to that audience Q&A. We will have that audience Q&A towards the end. You can put your questions in a few different ways. You can use the chat function, and we'll get to as many as we can. You can also use the raise hand function, which is down in reactions, and we can call on you. You can ask your question yourself to our fantastic group of guests we have tonight. And then the chat is also open for any reactions you want to share throughout. Of course, please be respectful, like our audience always is. But we'll also be putting any links to resources or things that our folks on the panel here tonight are talking about, so that you can access those. So I think we have quite a few answers to the poll. If we want to end that, we'll see who we have in the room as far as impact investing experience. So most people, it looks like, have some experience, and then we have a handful for whom impact investing is brand new, and another handful of experts, it looks like, in the impact investing space. So a nice mix. I'm gonna close that from my screen now. So I'm really delighted that tonight I'm hosting this event in partnership with our friends Tonic. Tonic is a global action community for deeper impact investing. Their membership includes individuals, family offices, and foundations from more than 25 countries who are active impact investors. Tonic creates community, provides educational resources, and curates investment opportunities for its members. And we wouldn't be able to do this tonight without their expertise. So I want to thank Tonic so much for doing this with us. I'm not going to say too much more about them because I'm going to dive into a conversation with their CEO, Adam Bendell, now. Adam has been running Tonic. Is it 5 years now? 5 years now, and has a phenomenal and interesting career that has spanned law, technology, being an entrepreneur himself, and of course being an impact investor himself as well for at least the past decade, possibly longer as well. So, welcome, Adam. I am really happy to finally be doing this event with you. I feel like we've been talking about doing something for quite a while.
We have. It's great. Great to be here. Did you mention, battery powered and battery guy? So, that too, right?
That's right. He's part of our.
This is my community too.
Exactly. So, so we're delighted to be tapping into your expertise. Well, I know you and I are going to have a chat and to kind of do some kind of ground setting around impact investing, and then the kinds of investments that can be made in climate. But then we're going to turn it over to one of your members who is going to walk us through her journey in impact investing for the client for the climate. So I thought we could kind of start from the beginning, you and I, in our conversation. And for that handful of our audience that was really brand new to impact investing, can you kind of talk us through what exactly it is, and is it the same or different from things like socially responsible investing, ESG, and other terms that we hear in relationship to impact investing?
Yes, a very good place to start because the lingo is confusing, and that is actually it's something that we work on a lot without, frankly, a lot of help from the industry generally, because people like the word impact investing. It's not, who doesn't want to be impactful? And so that word has been co-opted in various cases by investment products that we would not particularly describe that way. So let me give everyone a little bit of a framework, the way we think about this. And there's actually, if this intrigues you, or on the one hand, or is utterly confusing on the other, there's actually on our website, on the tonic.com website, a about impact investing primer that's not too many pages long, that goes a little bit more deeply. So we think about sustainable investing as the kind of broad umbrella that distinguished from traditional investing. So in traditional investing, we are concerned only with risk-adjusted financial performance. And non-financial factors are simply seen as not relevant to the business of making money, which is what in traditional investing we think we're all about. So sustainable investing sits in contrast to that. And we divide sustainable investing into three different categories, which I hope will be helpful. The first is what we call financial ESG investing. So ESG, if you're not familiar with the term, stands for environmental, social, and governance factors. And these are things like concern for climate change would be an environmental factor in the E. Social factors might be things like the number of women on the board of the company, or whether they've got pro-family policies. And governance factors are things like, fundamentally, whether the company is well governed, whether for example, the chair and the CEO are the same person or are separate people, as is a best practice in corporate governance. And those three areas, environmental, social, and governance, come up with a much broader list than I gave you of factors that can be considered in investing. In the financial ESG approach, those factors are considered only to the extent that they would impact the medium-term financial performance of the company. So if we think that, for example, we've got a plant that is built on a low-lying island, I'll try to keep most of my examples in the climate zone this evening. and we got a plant built on a low-lying, archipelago. That's an ESG risk, whether you're a financial, whether you care about climate change or you don't, right? Even if you're just a traditional investor and you care about money, you probably care that the first floor not be filled with water as ocean levels rise. And so a financial ESG investor would look at that risk and factor that into what should be paid for the stock or the equity of that company. The second category is a values-aligned approach. And here we're adding in ethical considerations. We're thinking about, even if there might not be a financial impact an impact on the financial return of the company, we care because we care about climate change. And so, for example, we might divest from fossil fuel companies, invest in clean energy companies, because we want our money to be aligned with our values. And that's a way to do it. The third and the deepest category of sustainable investing we call deep impact investing, or investor contribution. And this adds an additional level of difficulty to the high dive, which is that we are looking as investors to place our money so as to cause something to happen that would not otherwise happen from a social, environmental, or governance perspective. We are trying to create additional positive impact in the world, social impact, environmental impact, that otherwise wouldn't happen. And so to do that, simply buying a good stock, let's say, let's without debating Elon Musk's character tonight, let's just say that we think that Tesla is a good company because they are motivated by contributing to fight climate change, which is very clearly at least part of the motivation for that company. So we think that Tesla's a good company. Well, if we just buy Tesla stock in the stock market, we're not having any contribution or additionality. We can't call that deep impact. We might call it values alignment because, we're climate investors and we want to own, we want to hold sort of good for the planet companies, but there wouldn't be an additional contribution because the commercial investors, in Tesla's case, a lot of day traders and so forth, are very happy to give Tesla as much money as they need. And anyway, we're buying in what's called the secondary market, right? In the stock market, where Tesla doesn't really know or care exactly who the holders are. So with deep impact investing, we're looking for that additionality, that investor contribution. So that's a brief introduction to a complicated topic. I hope it's understandable.
Well, you gave us some nice examples of like ESG and values line. Could you give us an example of what a deep impact investor contribution might look like?
I will give you an example of a company that I invested in called Sanergy, from which I'm delighted to say I'm in the process of an exit. My wife and I invested in Sanergy, I don't know how many years ago. So Sanergy was actually created. It exists in Nairobi, Kenya, and it provides sanitation in the slums of Nairobi. It's very hard to find a proper toilet in the slums. The conditions are frankly disgusting. And so they have created basically toilet kiosk model where they have little entrepreneurs, micro entrepreneurs who have toilets to provide sanitation in the slums. So addressing a very directly addressing a very significant problem. And then they actually recycle the waste and turn it into fertilizer and other products as part of this kind of value stream. They were not able to raise money from non-values aligned investors when we invested. It took impact investors to do it. So there was this additionality because, unlike Tesla, Sanergy couldn't easily raise money in the public markets.
Got it. And so when you say deep impact is an investor contribution, does that also mean investment of your time and expertise, or is that a different?
Surely could, right? I mean, we think about all the different aspects of capital. So financial capital is one, but there's human capital, there's natural capital, there's our networking capital. all kinds of ways that active investors can contribute to companies that they provide financial capital to as well, but it's not required, right? Okay. So when we wouldn't require, if we're trying to categorize something as deep impact versus values alignment, we wouldn't say, well, are you also sitting on the board? That wouldn't be necessary.
Got it. So you can have investor contribution and deep impact without saying, oh my gosh, and now I have to put all my time into this thing as well.
Hey, Colleen, I see a question in the chat on deep impact. Do we want to? Oh, I got a direct message. Sorry.
Oh, you did. I was going to say I don't see that.
No, can
yeah, please go ahead.
Answer it. If I may, just pick it up along the way now. Is that good?
Yeah, please. Yeah.
Yeah. So the question is, how do deep impact investment returns differ? And there might be the implicit question there: is it necessarily concessionary or sub-commercial? And the answer is not necessarily, but often. So deep impact investors often start from the premise that benchmarks and market rate returns are flawed because they systematically exclude externalities. And now I see the video going off on all the people who didn't go to Econ 101. So let me just explain that briefly, right? In classical economics, any effect that an enterprise has that does not it's basically not contained to the enterprise, doesn't have an effect on the financial performance of the enterprise, is called an externality. So as an example, pollution that you will never have to clean up, classic externality, because you can pollute all you want, and if you don't have to pay to clean it up, who cares, right? That's a cost that's borne by society. Who cares? He puts in air quotes here. So so pollution is the kind of classic externality. And while some amount of pollution in the modern day is regulated, right? Pollution cleanup is regulated. There's still things that are not. And so there are externalities particularly in environmental areas, but in all the different dimensions that are not reflected in the company's financial performance. And so benchmarks like the S&P 500 index, for example, exclude a bunch of externalities. So impact investors often start from the premise that those aren't really the appropriate benchmarks. We're interested in benchmarks that include the effects of business operations on the planet and its inhabitants. And so if that is the case, and if we see ourselves as privileged and having excess resources, then might we take our money and deploy it for something that's sub-commercial, less than market rate return? It's not a grant, it's different from philanthropy, and I know you and I will talk about those differences in a bit here. But I might get less return than the purely commercially minded investor would be willing to take.
Yeah, I'm so glad because that was going to be one of my questions. So I'm glad that you took that one. And you referenced philanthropy, so I'd love to go there for a minute. We very much see, and we've had this conversation for years. You and I, that philanthropy and impact investing are complementary to one another. So can you talk a little bit about that and a little bit about the kinds of things that are ripe for philanthropy versus those that are ripe for, impact investing, what that looks, the differences there?
Yeah, you bet. So I think we started having this conversation and many others started having this conversation, Colleen, because perhaps in the earlier days of impact investing, a term that's been around for probably 14 or 15 years now, you would hear people say, well, why should I give a grant when I could invest for good and get financial return? That sounds like the best of both worlds, right? Can't I just do that instead? And what turns out is, you can and should, we think, do both. Most people are investing a lot more of their net worth than they are giving away each year. In fact, I don't know anybody currently for whom that isn't the case. There are a few amazing examples in history, but not so many. And so let's say that you got 99% of your wealth is being invested, and you're giving away 1% this year, which might even seem like a big number if you think about it in the perspective of your overall resources, right? Well, that 99% might be working against the 1%. So let's say that you're a real climate, you're actually fired up about the risk of climate change as a kind of existential risk to the planet, which I would imagine most of the people on this call are to some degree, because here you are tuning into this conversation and involved in this particular theme in Battery Powered, if you're a Battery Powered member. So you might be doing grants and or giving donations to climate active philanthropy, while you are invested in some of the most greenhouse emitting and kind of most egregious fossil fuel producers and so forth, which, by the way, doesn't necessarily mean, just to pick on a company that we love to pick on, Exxon, doesn't mean that you directly hold Exxon stock. You might just hold an index fund that holds Exxon stock. That's how most Exxon stock is held now. So if you're not paying attention to how the bulk of your wealth is being deployed, there's a pretty good chance that it's working against your philanthropy goals, your impact goals. So that's kind of the first thing, just as a kind of framing factor. And then the next question is, well, what do I do about that, right? And so, should I invest everything? How do these things sort of sit side by side? And I think, the second kind of framing thing, particularly for something like climate change, like what a huge issue, right? We need every tool in the box to address climate change. We need philanthropy. We need investing, impact investing, but we also need government action, and we need somebody who's going to change, consumer attitudes, and we need the work of NGOs and right? We need everything. And so these impact investing, philanthropy should be thought of as tools in the toolbox, all of which can be deployed against a really big problem. So when we're trying to decide whether to invest or give money for a particular topic, one of the ways you can think about that is it investable? Because the classic sort of, give a woman a fish or teach her to fish. We would rather teach someone to fish, and investing has this kind of sustainability built in, that it can sustain itself without ongoing contributions over the long run, one hopes. That's an advantage. But many problems aren't really investable. Either there are a lot of climate things that are just too early for investing. It requires big science to solve some fundamental problems. I think about, carbon sequestration as an example, right? I mean, there are some investable things, but there's a whole bunch of science we need to work out before we go experimenting, with certain things that might, whatever, I'll leave it there. So I think some things are too early to invest. I think some kinds of direct humanitarian support are never gonna make good businesses, right? So let's go back to the archipelago at risk of rising sea levels, where my plant is underwater now. Well, so are the homes of all of the people who work there. Who's going to pay for that? Who's going to provide direct humanitarian assistance? Well, that's probably going to be the role of philanthropy. And then there are issues that, it's maybe not either of those, but they're just not investment ready yet. There needs to be, oftentimes philanthropy plays a kind of catalytic role in making something investable. And an example of that, which is also an area that my wife and I have invested in, is animal welfare. If I had told this crowd a few years ago that you would make a killing investing in plant-based foods, they'd say, "What are you, some kind of crazy vegan?" After saying, yes, I am, I would then say, well, yeah, we think that there's an investment thesis there. Well, now after the Beyond Meat IPO, which I think is still kind of the best performing IPO of the last 15 years, there's a rush of investors interested in plant-based foods, but philanthropy first, and then impact investing after really paved the way for the commercial investors. So you can think of this as a kind of journey that is often paved by philanthropy.
Yeah. Yeah. I'm reflecting back on our conversation Monday night and expert night where they really emphasize the critical importance of like movements and power building in communities that are most directly impacted by climate change, and how, social change has never happened in our country, at least, without that kind of people power and community organizing. And that is, I think another good example of like, that's not an investable opportunity. That's a philanthropic opportunity. And it's also critically important to climate action. So that's a good linkage. Okay, I wanted to ask you, like, there are lots of people interested in impact investing, but it feels like there are barriers. What are some of the common barriers that you see for people getting started with impact investing? And how do you dismantle them?
Yeah, well, the first thing is you might be told by your current financial advisor that you're nuts. I was. Not my current, but I was told at the time, hey, Adam, you seem like a smart guy, but you are so fuzzy-headed about this. There's philanthropy and there's investing, and there's nothing in between. You're just going to mix them up and get very confused. And that is a very outdated, but very common still perception that keeps a lot of people from doing this kind of work. And so if you are interested in impact investing, or at least in values alignment, in sort of aligning your money with your values, then you need to find help that won't fight you on that. And there's plenty of help that won't. That can either be bringing your advisor along for your ride, or it can be finding someone new. I think a second thing is that this is an emerging field. There's a lot of chaos. Things are not all ticked and tied in nice little boxes. And so there is a lot of confusion, for example, about terminology. You started with, what's the difference between socially responsible investing and ESG and, blah, blah, blah. I mean, these terms get thrown around in ways that aren't necessarily that helpful. And so that is also a barrier for people. It's very hard to use the labels on investment products as a good guide to where the true impact is. And so you need help from somewhere, somebody, you need a little help from your friends to sort that out. And that's maybe the third thing I'll say is that little help from your friends. It's a little bit lonely, right? Like this is, way less than 1% of global assets are managed as impact investments. A much bigger percentage, by the way, are broadly sustainable between financial, ESG, and values alignment. Estimates are maybe as much as 40% of global assets, with in Europe, much more emphasis on values alignment. In the United States, more emphasis on financial ESG, but impact, deep impact, it's a tiny percentage still. So it's lonely. You need friends. That's why people join things like Tonic, where they can find other people, like Jennifer, who will speak with us shortly, will tell you, who you can bounce ideas off of, who can originate deals, where you can, if you're new, you can kind of ride on the coattails of more experienced investors as you kind of get started. And so I think all of that, plus just the need for support and the kind of, the kind of fundamental attitudes of traditional investing that we inherited, all of that is why this isn't a natural thing that just happens.
Mm-hmm, mm-hmm. Well, maybe that's a good segue then to Jennifer, who we're going to hear from about her journey in impact investing in the climate space. But could I ask you to do the honors of introducing her, Adam?
I would be delighted. So Jennifer McFarlane is a very active member of Tonic, but also has had a distinguished career as a CFO at both public and private companies, an investment banker, a board director, both for-profit and nonprofit boards, where she supported I think mainly tech-based companies, right, Jennifer? Yeah, on product launches and global expansion, but in a pretty wide variety of industries: clean tech, industrial biotech, med tech. Um, and she got her bachelor's from the University of New South Wales in Australia, and then an MBA from a modest business school in Palo Alto, you may have heard of, called Stanford. And Jennifer recently founded Astera Partners, which is focused on using revenue-based financing structures to provide capital to emerging technologies that need to scale up. If that lingo doesn't mean anything to you, revenue-based financing, we're not going to get into that tonight. Unfortunately, maybe we'll do another event, Jennifer, because it's one of our favorite topics. But basically an alternative to debt or equity that is more win-win for the investor investee anyway, maybe for a future event. And Jennifer is also an active member of Tonic, and in particular, she's really turned her attention in recent years to the climate crisis and in using impact investing to address the climate crisis. And so that is why we are delighted to invite you, Jennifer, to share what you've learned with the Battery folks today.
Super, absolutely. And thank you very much. First of all, I am very excited to be here. I can talk for ages about climate change and impact investing. So I'm spoiled by having you as an audience. So thank you very much for listening. If you go on the next slide. So I'm going to cover a few things briefly. One is my beliefs and values. How did I get there? Then it's how do I apply that in terms of the impact investing? What was my theory of change? How did that translate into investment goals? And then some target portfolio. And here I'll just acknowledge this is a journey. I'm very much I'm 3 years into it, and I'm still got a long way to go. So first of all, some key insights, some bottom line insights before we start. One is there is no right or wrong. This is really about what you want to achieve with your financial resources. And that's a very important message to provide to investment advisors. It's also very personal and very individual. It's your unique position and perspective on the world. It is a continuous journey. And I'll also say it's an exciting journey. And actually go back to something that Adam said, which is the impact investing landscape is changing rapidly. The investment opportunities in climate change reduction and adaptation are changing day by day, and it's extremely exciting and energizing to see. So on to the next slide. My values and beliefs around climate change. I actually might just start with how do I even get into climate change? And it was actually over 20 years ago, after 10 years in investment banking, I went back to Australia to join a company as executive director, a public company as CFO and executive director, i.e. on the board as well. And that company was developing a technology to produce oil out of oil shale. Now you don't need to, all I can sort of say is it makes oil look clean, to give you a perspective. It's really bad. And in the end, we were under attack by almost everybody, including Greenpeace. I ended up, for some reason, taking the mantle of developing a sustainability strategy. How do we make this horrible greenhouse gas intensive technology less horrible, which we about as good as you can get. And I found that I was actually more aligned with those that were trying to do good on the other side. So I sort of realized, oops, I'm in the wrong industry, and I found something exciting I want to be involved in. So I was with that company for about 5 years in Australia, then returned back to the US. I took a role at a nonprofit for two or 3 years, and then most of my career since then has been scaling new technologies in climate, addressing climate and biofuels and solar, et cetera. And right now I'm on the board of a carbon sequestration company. So my life has become really around climate change. And I stopped being a full-time CFO about 3 years ago. And that's when I joined Tonic, because I recognized I wanted to align my investments with the beliefs that I had developed over a career. So let me just frame them for you. Part of this is a larger context, is that humans have responsibility for the planet. The worst issue that we've created is perhaps climate change, but it's not just climate change. We need to live within the capacity of the world. That includes addressing issues of water and biodiversity, oceans, etc., clean air. But this is essentially, the climate change is the number one. And what you'll see on the right-hand side in green is the SDG sign for climate change, which is 13. But looking at this holistically, it recognizes you can't just look at climate change in the isolation of the bigger context. And that is basically felt that it's almost inhuman to address climate change without addressing and considering your other fellow human beings and addressing poverty. It just doesn't make sense. So I believe alongside poverty must be addressed in one way that links to climate change, that's providing access to clean energy, particularly in emerging markets. And the other is making sure everybody has basic needs. And this is globally, it's not just in the US, although it also appears in the US. So I sort of regard them as you need to move on both. And that's becoming far more important appreciated far more with environmental justice movements. Finally, I always think about root causes. And I believe that there's probably two key root causes between why we got here with such a horrible impact on the planet. One was we didn't have enough diversity in decision-making. And the second is the focus of corporations on the bottom line profits and not more of a stakeholder focus. So that's this other, if you look at just addressing climate change, it happens within a larger context. The result is that if I look at SDG 13 and access to climate energy, that component comprises about 60% of my target portfolio, with other things doing with poverty and diversity and water being the remaining 40%. But all my time is on climate change because that's my professional expertise area. So next slide. Okay, so my theory of change, and I'll have to say, I'm sorry that you're looking at such an awful, ugly slide, and I'll try and make it simple. Developing nice slides is not my forte by any means. I wasn't in marketing. So basically, theories of change, first of all, climate change is a huge issue. In order to achieve that, the goal is implementing solutions. This is going to the right-hand side, implementing solutions for 1.5 degree C warming at the most. And it is estimated to cost perhaps $2 trillion per year, if not more. It is a serious financial commitment. And that is only for dealing with solutions. It's not even thinking about the money that's going to be required for adaptation, which is also living in that level of investment. So if we look at this issue really requires, we look at the green arrows, every organization, everybody involved to be engaged in it. Investors have to be engaged, corporations have to be engaged, individuals have to be engaged in terms of changing consumption. And the green arrow, the biggest one, is the government. And this, I'm using this because it ties into, I think, a key role of NGOs. So the government, it actually has it has 4 different levers. That's how impactful it is. It issues regulations, both environmental, but also financial, which is having an increasing appreciation of the potential impact. It supports the R&D that is too early to be supported by commercial funding. But we shouldn't also forget that it has huge procurement power, which I think Biden is recognizing in how it's directing in some of his original initial priorities, is the power to buy new solutions, to be an early purchaser and to purchase in scale is a tremendous incentive to invest in solutions. And then finally at the bottom, I put in infrastructure dollars, because that really is, it's infrastructure mostly it's going to be going for adaptation. And if you want to look at addressing equity in relation to climate change, protecting the poorest against the impacts of climate change through infrastructure is one of the most important areas and should be as visible as some of the other things. A simple example is the Bay Area received well over $100 million a couple of months ago to address impacts of flooding. Where is it going? Is it going to benefit myself, or should it benefit the people in East Palo Alto? All right, so moving along, other actors, if we go to the top, we've got investors are important actors in terms of allocating money to new projects and technologies, as well as engaging corporations to improve their behavior. The leverage of money, it's always following the money, is huge. So engage corporations to improve their performance and to invest in leaders. At the bottom, we also have individuals who have power as employees to engage with their corporations, as we've seen, and also to change their consumption habits. Then finally, on the left-hand side in purple, we have NGOs, and they play a unique role in the ecosystem that is essential. And it's engaging investors to be more impactful and more active with corporations. It is very importantly influencing government through developing policies that I think are more broadly based, mobilizing investors, and then of course mobilizing consumers and employees. So move on to the next slide. Okay, so I've got a question in terms of invest in leaders. It's a very good question. I believe in investing in leaders in terms of, and I will actually get into this more detail, it's leading those companies that are leading their industries in terms of addressing climate change, includes as well as companies that are leading in solutions. So you need both. You have both equation, both the leaders in the industries. I call them, that's the demand side of the equation. And that's essential. You have to have the demand, otherwise the solutions don't exist. So it's both. Now, in terms of theory of change funding sources, I'm almost basically repeating the prior slide, but putting it into the context of funding sources. So clearly, with $2 trillion per year needed, along those lines, or not more, we need the normal commercial markets to do such things as invest in projects, technologies, in corporate leaders, and engage corporations. We also need, on the furthest right-hand side, the philanthropy to support regulations, mobilize investors, and also support grassroots NGOs. But I also want to raise up here that there is this sub-market, almost impact, real deep impact investing component as well, because there are market failures. But and the key gaps that sub-market or impact investing, deep impact investing can address are solutions for the poorest, which I think Adam alerted to. Also funding gaps for innovation, because there's some that isn't addressed by government, is too early for traditional investors. And then new financial structures. And that actually is becoming increasingly important, is new financial structures such as green banks, green bonds, that can be scaled to commercial to mobilize the 2 trillion. Okay, so over to the next slide. So almost there, 2 more slides. How do we translate this into, how do I translate into investment goals? And first of all, I'll just say it's individual for everybody. And this is not a recommendation by any means, but it's more, everybody has their own objectives and their own constraints. And so this is a framework of my own objectives and constraints. So my biggest constraint is a risk return of 90% at market, which means that I'm allocating up to, but no more than 10% to sub-market investments. The liquidity target is 50%, 85% of is within 5 years, which means things like private equity, which is typically 10 years plus, it's limited to about 15%. My themes are leaders, and that I mean the industry leaders, solution providers, and infrastructure. The simple metric that you can use for climate change is greenhouse gas reduction. I use the word ideal because the amount of reporting and data availability really doesn't allow you at this point to sort of say, okay, I've reduced carbon this year by X% through my investments, but it will come. So that's the metric I'm looking at. And the consequence is my asset classes are below. Public equity, 50 to 55%, private equity, 10 to 15%, private debt or hedge, 20 to 30%, and submarket up to 10%. So we go on to the final slide. So what does this mean in terms of investments? Examples. If you start with the orange slice, so the orange slice, which is there about 55%, represents the public markets. And at the top, we've got reference to solution funds, and at the bottom is climate leaders. And I've developed a customized index with ethic. Stepping back, I'll just say in terms of having impact, going to the biggest way to augment impact in public markets is to use your vote. So it is really being an active investor. And if you are investing or in mutual funds, ideally work with a mutual fund that is an activist investor. And there are a number, including one that I've invested in. So voting is critical to augment. In terms of the industry leaders, I've developed this custom index. I'm really focused on the leaders that are really showcasing the ways that those that are actually going to the government saying, we want real regulation. To improve, to address climate change. And this is a reality of the market development stage in terms of greenhouse gas. I didn't find an ETF or a mutual fund or a separately managed account that to me really invested in true leaders. And I can go a bit more into definition of true leaders, but I had a more of a purist perspective. So I ended up developing my own index with ethic. Then the other half is in solutions, which are those that are commercializing new technologies. The one that I think I like the most is AGPIX, which is part of a fund out of Canada called AGF. They've been doing impact or climate change investing for about 20 years, and they are an activist investor. They're very, this is done tremendously well. They're astute. They basically don't necessarily invest in end solutions, but also in companies that are part of the supply chain, for example, if they feel that's a better value. So that's the advantage of having, one of the advantages of having an active hedge fund. So I move over to some of the other investment categories. We have the red category, which is private equity. And there I have 3 investments as examples. LanzaTech, which is developed a technology that converts waste carbon monoxide from industrial stacks, such as steel companies, into ethanol and aviation fuel. So it's a carbon recycling story. Full Harvest is also a food waste recycling story, and Voltaic is a software focused on implementation of new batteries and EVs. So moving on to the purple version, which is the private debt and hedge funds, you'll notice there's a couple of question marks. Those are ones that I'm seriously interested in, but need to do more due diligence. The one without the question mark is Atlas Impact Partners, which is a long-short hedge fund for basically solution providers. Oh, I'm just reading a little note here. Okay, I'll get to that note a little bit later. So the Atlas Impact Partners does long short in terms of solution providers and shorting sort of the worst actors, for example, the oil companies. And part of the intention behind that investment for myself was to say, Atlas isn't yet institutionalized size. So I know there are institutions saying, we want to see you get it to a certain size before we'll invest. So this is a way that early impact investors can play, is being early investors in new types of funds that have to grow larger before they can attract institutional, but they have the strategy that can be implemented at institutional stage size. Another example along those lines is Impactive Capital, which I haven't yet invested in. It is a hedge fund that is an activist hedge fund on ESG. So again, it isn't yet institutional scale, but it has the potential to become institutional scale. What I like about it is it basically takes meaningful positions in companies that can improve their bottom line through improving their ESG performance. In the mid-market, there's a lot of attention to Fortune 500 companies. The rest of the world has been more neglected in terms of their ESG performance. That's one that I'm seriously looking at. At the top is the sub-market investment, and there is SUNFUNDER, which I recently invested in, which provides debt financing for commercial solar installations in emerging markets. Again, it is still sub-institutional, but has the potential to become institutional. They just raised as part of a $70 million fund, which has only, frankly, DFIDs, European government organizations and impact investors in it. And so I think that's it. And I'm happy to answer some questions if I look at the chat.
That's great, Jennifer. Thank you so much. As you were going through, I had all these questions, and then this is systematically tick them off as you got to answering them. But we did get a couple of questions in the audience chat. We are moving into time for audience Q&A. So if you have a question, pop it into the chat box or raise your hand. I'll try to see all the little raised hands and get to you. But I do see one in there that I would love, I think, to kick to you, Jennifer, but you might also have something to say about it. Adam, can you go a little bit deeper on how you balance and evaluate returns with the desired impact outcomes to determine if the investment was a success? Like, what's your definition of success, and how do you balance those two?
Adam, would you like to go first?
I'm happy to. So it's a great question. And the answer, yes, plug and play is the next question that popped up. And so it pops into my mind as what this isn't, is plug and play. So right now, the development of modern portfolio theory, which is what underlies sort of, financial diversification and the way that most traditional investors invest, has boiled things down to some very common standards. We have things like return and risk and volatility, which is measured in beta and alpha. And you don't need to understand any of this except to understand that these things, we've been at this for probably, modern portfolio theory since, probably Harry Markowitz got the Nobel Prize for his work in the 50s or something like that. Impact investing is a lot newer. So the integration of impact return and financial return is still a bit of a work in progress. That said, we think about two aspects on the impact side. One is, what is the expected impact? So just as you would make a decision about what is the expected return, correlated with the risk of a financial return, correlated with the financial risk of an investment, you would ask yourself the same question about what impact do I hope to achieve? And so that's what Jennifer means by theory of change, right? That she's got this idea that if I do this, I will cause this to happen and avert, this amount of greenhouse gas emissions, for example, in a climate investment. And then the second aspect, so again, a corollary to the finance side, is risk. What is the risk that the expected impact that I hope to achieve will not occur, or will not happen as quickly as I hope, or as much as I hope? So those two dimensions, impact return, impact risk, get arrayed alongside financial return and risk and liquidity and diversification, the other aspects of building a portfolio, and balanced against each other. So you can think of impact return and risk as additional constraints in portfolio construction. So to answer the question of sort of like how do you evaluate those? Obviously, at that point, it starts to become very unique to each individual investor. Are you willing to play in the sub-commercial, or what Jennifer calls the sub-market space, or not, in order to get outsized impact returns. You can play both ways. The answer can be no, and you can still have impact, but you go deeper if you are willing to relax that. Sometimes you'll be positively surprised, as I was in Sanergy, sometimes not so much. So that's the answer, is to kind of think about them as additional dimensions that need to be managed as you build a portfolio, at least at the high level. How do you think about it, Jennifer?
Well, I'll start with just recognizing that on the public market side, impact is an elusive concept, to be truthful. I will say that I have a fundamental belief is that but buying shares is like voting. So even though you're just a small participant, it's to some extent come to the game and play and vote. I vote by buying the share. The other is being active as a shareholder. And so success, for example, would be AGPIX, and what does it report out as its voting results or coalitions that it has participated in the last year as a fund manager. In relation to ethic, the ethic climate leaders portfolio, my definition of success would be, are the climate leaders still continuing to push the envelope of what's appropriate within the industry and increasing things like their commitment to science-based target commitments and greenhouse gas reductions. So, but I don't think I'm impacting the corporation. I'm just sort of saying, have I done a good job in selecting those that are showing leadership? Really more impact does come with the SUNFUNDER, and my success in terms of SUNFUNDER and investing in supporting debt financing in emerging markets for solar projects is its next fund, which is hoping to, does it scale to 100 million or not? I'm more interested in them scaling to 100 to 200 million in the next fund than I am necessarily getting a full return. I could get a sub-market return. They are taking additional risk in this fund that they hadn't taken the prior fund. They're expanding the geography. So they're positioning for the next fund to be institutional. The question is, are they going to be institutional next fund? And in terms of the private equity investments, it would be varies is, could you measure it by impact of greenhouse gas reductions? And honestly, we don't yet have those sort of metrics, but that would be how I would measure the impact.
That's great. Jennifer, there's another question that I was going to ask you as well. So I thank our audience for coming up with this from Kurt. What is you showed this really great, portfolio of impact investments that you have across different categories. So what is your sourcing process? Like, how do you identify those investments, and what's your sourcing process under each of the categories?
And here I just did my biggest omission, which is to say it's all due to tonic.
Tell it, but how does that work? What does that look like? Do they bring investments, to you?
I guess, first of all, let's say I probably have a little bit more financial background and industry background than most. So I come with an ability to do more personal research. I'll say, but the whole journey it started day one by joining Tonic and actually working with and talking with others and thinking about theories of change and so forth. In terms of sourcing, I tend to do it I'd say I'm doing it myself, but I would say as much or more I'm doing within the Tonic community. I do not have an advisor in most of my investments. There is an advisor that worked with me in terms of creating the custom index, but the rest of it is done by myself. But it is generally there's a climate impact working group within Tonic, and that has accelerated my investment because more investments have come up into Tonic, and I've been able to share due diligence, which for me I find invaluable, absolutely invaluable. So I have to say, Tonic, I blame Tonic.
We accept the blame.
No, that's great. And Adam, you started to touch on this, but for folks who might, and we're going to get to in very shortly here, we're going to point you guys to some resources for those of you who are interested in taking the next step and learning more or taking the first steps into impact investing. We're going to give you some resources to start on that path. But we did have a question about sort of plug and play impact investing option. Like, do you have any recommendations for maybe simpler ways for folks to get involved? One of the, I actually should have asked you if you even recommend this, but one of the things that I love is the Fossil Free Fund website, where you can actually put in the different indexes that, you know, the mutual funds or whatever that you're invested in, and see if they are invested in fossil fuels. And they give recommendations for ones that are not invested in that. So is there anything like that that you can recommend?
Yes. Dipti, can you put up in the chat while I'm talking As You Sow's website? So As You Sow is a local, locally based but nationally focused nonprofit that really focuses on answering that question, on sort of helping the general public to pick particularly public equity investments that are values aligned, we would say, at least, if not sort of positively impactful. And they have a number of screens that you can use including one on climate, but on like prison, they have a prison-free fund, that screens out private prisons, and a bunch of, gender, bunch of very interesting things that our members use as resources in the public asset class. This is the plug and play. So plug and play has two kind of limitations. So that's kind of a resource that I think of as a kind of good place to get started. A couple of limitations. One is that that's going to be limited to the public equity asset class for the most part. So, and as Jennifer's pie chart shows, there are at least 5 or 6, or depending how you slice it, 11 other asset classes, and that's much harder to source in any kind of plug and play way. Of course, retail investors tend not to be so invested in private equity and things anyway, so that's a good place to start. The other thing is sort of depth, right? It's much easier to get to values alignment than it is to deep impact, but values alignment is great. I mean, this is the place that most people start, right? Because deep impact does take more knowledge and more work. But values alignment is really accessible, and it's a combination of divesting and investing, which is terminology that comes out of a movement from several years ago from big foundations to divest from fossil fuel companies and invest in clean tech and clean energy and climate change fighting companies. That same approach can work in any kind of issue area that you're interested in. You don't want to fund private prisons? Figure out which companies you hold through index funds that or directly, that fund private prisons, and get rid of them. Buy companies that don't do that. So that's a divest approach. And then the invest side would be basically to overweight good companies. And there are, some mutual funds. I think I don't want to name any mutual funds particularly, but if you look around, you'll find some that really focus on world positive. And so that's probably some ideas of where to start.
Well, I think I'd love to turn it over to you, Dipti, because you're going to provide folks with some resources that they can turn to. And maybe you can, one of our audience members did ask what is involved with becoming a member of Tonic. So maybe if you don't mind answering that question in your bit here as well, that would be great.
Yeah, sure. It looks like yeah, so what I'll do, a couple different things. Hey, I'm Dipti Pratt at Tonic. Really excited to be here with you guys tonight. Thanks for hanging in. But what
I'm sorry I didn't even introduce you, but Dipti is one of our friends and colleagues over at Tonic. So thanks, Dipti.
She's the boss of the West Coast. Dipti is a deep resource.
So anyway, so what I'll do is a couple different things. One, I'll share a little bit about what Tonic is. I'll pop into chat some resources, and then I think Colleen and Nicole and Joe will just send up a follow-up note with incredible resources to check in on. So for those of you who don't know Tonic, we're essentially a global community of individuals and family offices and foundations all accredited investors who are essentially thinking about exactly what Jennifer and Adam and Colleen shared. How do you really seek this deeper impact in investment? And how do you really think about it in a meaningful way? Tonic's mission is very much around catalyzing that deeper positive impact across all spectrums of capital. And so you're going to see that across asset classes. And so we do this in a couple different ways. The first is membership services, which I'm happy to touch on in a little bit. But the second thing, and really where I want to spend most of my time chatting today, is around this field building work and how do we essentially grow and support the global impact investing ecosystem, understanding that it's early and that it's young. So what I'll share with you in a brief moment is our Impact Terms platform, which is a resource where you can really go wonky around the idea of revenue-based financing or other models and get thoughts and perspectives around that. We also put out a number of research reports. We have our T100 research, and that gives you access to kind of research, to reports, to thoughts, so that you can really think about, like, what are the best in class investors doing? And I'll also finally add into chat in a second, as soon as I'm done screen sharing, really what's Tonic's approach to impact investing, which is a bit different. As I mentioned, we are a membership organization. We are a global community. And so what we're doing is really there to support one another, much in the same way the Battery brings together each of you. This is the same thing that we do for impact investors. And so it's a great opportunity to connect and sync up with your peers. We also provide incredible educational experiences, understanding that individuals are on all points of the spectrum when it comes to impact investing. And so really meeting you where you are and encouraging you to kind of go along your journey, knowing that it's going to take many different paths. And then someone asked Jennifer earlier, looking at how do you source deals, Tonic also provides opportunities for you to see deals that other Tonic members are supporting and investing in personally. And then finally, we also provide support. So we have a Tonic Tracer platform that actually allows you to really lean into your portfolio analysis and say, am I getting the impact returns that I want to see? Am I actually doing what I intended to do? And this is really all around Tonic helping and supporting you in your journey. I've left my contact information. I'll put it up in the chat later, but essentially happy to chat and share more. And with that, then I'll also pop into chat now that I can see each of you some resources to leave you with.
Thank you so much, Dipti. I realized that I forgot to do one of the most important things, that I was going to put up a poll, which I'm just going to do quickly now. We are really interested in knowing if you guys would like more of this. So if you could take a minute to pop into the poll question, if this is something that you'd be interested in seeing more of, this impact investing events and workshops as part of what we do here at the Battery and even with Battery Powered. So we'd love to get your feedback on that so we can decide how to go forward ourselves. I see, Dipti, you're putting in all of those links in the chat that you mentioned. So for those of you who do want to go further, click on those links. We'll also send out an email to everybody with some of these resources so that you can have that afterwards. And I see a question, can we send out your slides? One of our members is asking, can we do that? Dipti and Jennifer, you okay with that?
Yep.
Okay, cool. We'll make sure that we get those sent out as well to everybody. So I think everybody who wants to answer has popped in their answer into the poll. Going once, going twice. I'm going to close it. All right, let's see. Oh, a couple more people are coming. Wait, people are coming in. This always happens when I make the last call. There's always more that come in. Okay, so let me share the results. Yeah, okay, we've got interest. So that's great to hear. I mean, maybe this is an audience that was predisposed to being interested, but it's good to hear that.
Especially the ones who stayed in the end, right?
Yeah, exactly. I know, exactly. So maybe it was a skewed end, but still good to see that interest. Well, I think that's really it for us. Adam, Jennifer, can I invite you to say any last words before we say goodnight to everybody?
I'll say this. I joined the Battery to find people like you, to find the people who share my passion for leveraging the privilege that that I have into care for the world. And you wouldn't be on this call if you didn't have that care for the world. And so it's tremendously inspiring to me to have, you know, essentially a subgroup of people, a large subgroup of people in a social club in San Francisco who are so motivated and who act behind that motivation. So it's, you inspire me all the time. Thank you for all that you do.
Thanks, Adam. And Jennifer, thank you so much for being with us tonight. Any final words from you?
First of all, thank you for listening to me. I could go on for a long time. I so much enjoy this. I'll just encourage that every dollar sends a signal, and that it is very, in terms of my own life, knowing that I'm sort of values aligned in everything, sort of trying to be. It is on all different angles. I mean, I could never invest in Exxon, for example. And I think the field is evolving to enable more impact. Particularly, there's more different types of funds coming out that could have more impact. I would say thank you. And I hope that you find ways to take a next step.
Well, thank you so much to Adam and Dipti and Jennifer and Tonic for being with us tonight. Thank you so much to our audience for joining us this evening. This is wonderful. I have learned so much. So thank you all. I hope you all stay healthy, stay well. Hope to see you all at Battery real soon, reopening tomorrow with our outdoor space. So hopefully we can all meet in person soon. Good night, everyone. Take care.
Amazing.